going on, everybody? Good morning and welcome back to Beat the Bell. Hope you guys are all having an awesome week thus far. We missed you guys on Monday, but we are ready to rock this morning. Money Mander, good morning to you.
Good morning. Happy hump day, everyone. Phil's rolling. Good time to be alive and getting into earnings season in the markets here. So fireworks coming soon.
All right, Diamond Trades, good morning.
Good morning. Good to see the Phillies ripping. Happy for Sal and the entire city of Philadelphia. Gotta love that. Let's get after it.
All right, Fed forecast and economic calendar. Take it away.
Yeah, let's start with the economic calendar for today and this week. So far, this week, we had actually retail sales yesterday and several Fed speakers. Those are really like the primary news. Retail sales yesterday came in hot. We'll talk about that in a little bit. This is last week's economic calendar, Ryan. I didn't, that's my fault. But for today, we have, let me go ahead and pull it up. I know that we just had housing starts, which came out at 8:30. And then tomorrow is really going to be the big day with Powell speaking tomorrow. So Powell's going to speak tomorrow at around noon. Today, building permits came out more or less in line with expectations, 1.47 million versus 1.46 forecasted. So nothing really surprising there. Housing starts came in at 1.3 million versus 1.4 expected. So again, in line there, up 7% month over month on housing starts after posting a minus 12.5% last month. So housing starts jumping there on a month over month basis. But yesterday, retail sales came in pretty hot. So the forecast for retail sales yesterday was about 4%. I want to say 0.3% on the forecast. Came in at a plus 0.7% month over month, showing that retail sales is still strong. And the housing market index came in at 40 yesterday on a scale of 0 to 100 versus 44 previous and 47 expected. So the housing market, the NAHB housing market index cooling down as well. Let's jump over to the earnings calendar. Earnings season is heating up. BAC and Goldman and J&J all reported yesterday. Today, Tesla and Netflix will report after the close. We're going to have American Airlines and Taiwan Semi both reporting tomorrow, and then American Express is going to report on Friday. So that's going to be the earnings calendar for this week. This week's trading has been mixed, right? In the indices, geopolitical tensions and conflicting economic data has the market trading in a bit of a range. As of yesterday, as of yesterday's close, both the S&P and the Dow are up about 1% on the week, with the Nasdaq trailing with a 0.8% gain on the week. Active intraday traders will surely notice the relative weakness in tech so far this week. Some potential reasons that we could look at: one, yields resume their uptrend, with the 10-year setting new multi-decade highs following last week's less than stellar bond auction, questioning demand for new, longer-dated government securities. Number two, earnings season again kicks off this week with Tesla and Netflix after the close for tech in particular. So those they'll be like the first really like large cap tech names to report in this earnings season for Q3 earnings. And then third, new restrictions out of the U.S. government on Nvidia's sale of chips to China and potentially other countries as well, as tensions continue to escalate between the world's two largest economies. That had Nvidia down actually 7% intraday yesterday before it recovered before the close. It is down again in pre-market, if I'm not mistaken. I'll pull it up. Yeah, down about $10 here in pre-market off of yesterday's close at 440. So Nvidia definitely taking a hit on those new U.S. restrictions about where and who they can sell their chips to. Bank earnings we missed on Monday. We missed Beat the Bell on Monday, but we did have important bank earnings last week to close the week. So earnings season kicked off on Friday with a slew of bank earnings that proved largely positive. JP Morgan, Wells Fargo, and Citi reported over $22 billion in profits for the third quarter on a combined revenue of $81 billion, representing a 14% increase over the same period last year. Bank executives said profits were driven by economic growth, but warned of potential slowdowns on the horizon as consumers burn through excess cash savings built up during the pandemic. Large banks benefit from elevated interest rates as they make the spread on loans more favorable. Some CEO comments from the earnings that we've gotten so far out of the banks This may be the most dangerous time the world has seen in decades. That's from JP Morgan CEO Jamie Dimon. All of these macro dynamics have clearly impacted client sentiment. That's from Citigroup CEO Jane Foster. She continued, September is always a busy month seeing clients, and I'm struck how consistently CEOs are less optimistic about 2024 than a few months ago. JP Morgan said it has changed its base case forecast from a mild recession starting in the fourth quarter to the much discussed soft landing with continued growth through all of 2024. The U.S. keeps surprising us with its resilience, so I think it's hard to call. That's from Citigroup CFO Mark Mason. I do think we're likely to land things in a softer way than we thought. So mixed comments out of the bank CEOs, some of them urging caution, some of them saying that they're surprised by the resilience of the United States economy. We're seeing that again this week through economic data, obviously with the strong retail sales yesterday. Mander, what are you thinking about bank earnings and I guess the rest of the week here as we head into Jay Powell's speech tomorrow?
Yeah, I think going off the CEO statement you made, going back a few months, a lot less optimistic moving forward than they previously were, as they were saying their clients were noting. I think that's all coming down to the bond market. And I think that's ideally what the Fed has wanted here. And so if we could pull up the chart we just had up in a second, I think this is really hinting at what the Fed is trying to accomplish here. You can see the shorter duration of the curve here has really remained pretty much unchanged within a 1 year duration. But you can see going back to really the last FOMC meeting, and then I also threw in going back just a week ago, and so how we've seen that bounce off the lows in yields here. I think seeing this longer duration peak up is really hinting at what the Fed is trying to do, and what Jerome Powell really said they needed to do was get that longer duration to move up while keeping the shorter duration where it's at. And so kind of going back to last week at the start of the year, what we mentioned was the Middle East situation leading to that rotation into safer assets. And that's kind of what we saw with hedges going into the 10-year, going into the VIX, which caused that end of week sell-off last year, but also caused that pull down in yields that we saw at the end of last week and really the start of the week. So we got a rally and then a sell-off as you had the VIX hedges getting put on into the weekend. Coming into this week now, we're seeing all that roll off. And so the VIX hedges with no new developments over the weekend are getting rolled off, which are having dealers re-long to unravel the VIX hedges. But now you're also seeing the same thing in the 10-year with those hedges into the 10-year getting dumped. We just set that new fresh highest close since April of 2007 that you mentioned that. So I think we're kind of at a teeter-totter here in the markets. What I'm kind of watching is into the rest of the week, how the stock market is going to react to this move in yields. Because as you mentioned, we closed green on Monday after the gap up. We closed dead flat yesterday. We have not really seen a reaction yet to what's going on in the debt market versus equity. So that's really what I'm watching. And like you mentioned, really not any high impact news going into the rest of the week besides earnings, namely Tesla after the close today. So I think there's kind of a strong chance we remain range bound until we get through earnings season, or if we start to see consistent trends pushing into earnings season. But if we keep getting mixed bags between big names, I think we probably base here for a little bit before we get a decision which way we want to move. And I just wanted to cover Tesla's earnings reports coming after the close today. Wall Street expecting revenues of $24.06 billion, up 12.1% year over year, but EPS down 22.6% year over year to 74 cents, thanks to obviously the major price cuts they've been pushing seemingly every month. Automotive gross margin at 19% and free cash flow of $2.59 billion. So option market's currently pricing in a plus or minus 5% move right now. But if anyone, and I'm sure everyone has seen that with Tesla weekly chart, I'm personally expecting a bigger move than that unless we come in pretty much right at expected across the board. I think this one's coiled up for a much bigger move than 5% at the end of the week.
The last thing I wanted to touch on before we pass back to Alejandro is you mentioned that move into a bit of safer assets following the eruption of tensions in the Middle East. Gold, ever since the Hamas terrorist attack on Israel, gold is up about 6%. So a massive move there. I mean, gold doesn't move that much, so 6% in about a week is definitely a massive move there. Trading at like 1959 right now per ounce, off of the lows of the year too, right? Remember earlier in the year when we had sort of the banking crisis, and you saw all the gold bugs start to come out and say, see, this is why you need gold. This is why you need gold. And gold just massively underperformed from April, basically until now, getting a really strong bounce off the lows here and pushing up towards that September high. up at 1970. So definitely something to keep an eye on there, particularly as potential news of escalation comes out of that situation in the Middle East. But that'll wrap it up for us here for the forecast. Pass it back to Alejandro.
All right, thanks, guys. Let's take a quick look at the system here. So the main story here, we finally broke above the 1 hour 50 SMA, the SPX 1 hour chart. So we've been talking about the October bottom, typically coming in the first couple weeks. And so far, that's exactly what has happened. So despite the headlines, the war headlines overseas, the market has continued to see strength through the start of October. So seasonally, those last couple of weeks of September are weak. That's exactly what we saw. The first couple of weeks of October are strong. That's exactly what we've seen so far. Now, the past couple of days have been range bound. As we can see here on the 30-minute chart, we're getting sell signal, buy signal, and whatnot. So after these massive legs down or a rip like we got October 6th through the 10th, once you get a giant leg like that, we know that the market is going to chop around, and that's exactly what's been happening. And so now it's coiling up for the next leg. As long as bulls can continue to hold above the 50 SMA on the 1 hour chart, we should get a push higher up. And now bulls are in control, and that's the story. And that's exactly what we've been talking about. It's exactly what we anticipated. So it's nice to see bulls step in when they were supposed to step in. And it's going to be interesting to see if the month continues to see strength. Seasonally, what usually happens is we do see strength into the end of October. We get a slight dip in the middle of November, and then we rip through the end of the year and get that beautiful Santa rally to close out 2023. So that's what we'll be watching for. Obviously, there is a lot of headline-driven price action. This week is pretty crazy with the amount of Fed speakers. JPOW tomorrow. So keep that in mind when taking trades. But that's what the current landscape is. All right. So now we've got Bet the Bell. And we're going to start with green or red. This will be a little bit different because Snipes isn't here.
Take it away.
Oh, is that a question for me?
No. I was waiting for the stats to come up. So there are your stats. Noah starting to pull away. Unfortunately, let's start green or red. Starting with Money Mander.
I am going to take red today.
All right.
I'll go red as well. I like the downside today.
All right, I'll go green. I'll be the odd man out. All right, so Diamond, you have the questions, correct?
Yeah. So
cover.
Yeah, for sure. So in lieu of Snipes not being on the show today, I'll go ahead and cover his segment for Bet the Bell. One of the first things I want to talk about, and we mentioned that in Fed forecast, gold and oil both moving on sort of the reaction to first the Hamas terrorist attacks in Israel, and then obviously the Israeli retaliation currently ongoing right now. Is this something that you guys are expecting to affect the equity markets? I know that Alejandro was talking about that potential early October bottom, which is seasonally exactly what we see. Obviously, this year seems to be a little bit different, right? When you have these sort of headwinds coming in, and as Mander mentioned, people moving to a little bit of safer assets, and you have just these war-driven headlines sort of pushing price action around. Is this something that you guys anticipate will have a material impact, I guess, on equities into the end of the year? And I guess, does it change your base case for what you're expecting here into the end of 2023 for the indices?
I would say it doesn't really change my base case. The problem with this is it's going to be so catalyst driven. And so I saw this statistic yesterday based on previous wars where oil began to trade at. And really what it looked at is the longer the war goes on, the more obviously conflict and turmoil you're going to have around the oil market. And so going back to the Iraq war in the early 2000s, going back to in the 80s, I forget what war there was in the 80s. Pretty much every global war we have, oil begins to run just across fears of distribution and supply. And so I think the longer this goes on, you're namely going to see weakness, in my opinion, in tech, because with a strong energy sector, at least keep the S&P 500 afloat. but gold bets being placed obviously as a hedge to the markets, oil or yields ripping, oil ripping, these are all usually inverses to equities. And so I think under the surface, what you have brewing is not looking too great. But that being said, they could reach, a treaty or a peace within the week. And then at that point, you're going to have all the hedges just placed in the oil, in gold, in the bond markets getting dropped. And at that point, we definitely go straight back into seasonality into the end of the year. So in my opinion, it's a tough one, but I think it's definitely just worth watching.
I think in general, a mistake that a lot of traders and investors make is they take the war headlines and they try to formulate a thesis. Is this going to drive stocks higher? Is this going to drive stocks lower? I think it's really important to tune out the war noise and focus more on what the Fed is doing. So we've seen in the past this pattern of anytime a war starts, the war dip, quote unquote, is bought up. And so it's actually, you typically see a positive reaction for equities. But last year, if you guys remember, when the war started in Ukraine and Russia, a lot of people were saying, well, this is just going to lead to a rally into the end of the year for the markets. Typically what we see is the dip gets bought up whenever you have those war headlines to come out, et cetera. But the reason that's typically the case is because the Fed is able to take a more dovish stance. We typically see rate cuts, et cetera. That didn't happen last year. And so I think it's a good idea just to continue to monitor what the Fed is doing. Realistically, that's what's most important. Is the war in the Middle East going to affect how the Fed handles things? That's the real question to be answered. That's what investors should be watching for, not the million. I mean, it's so different. How are you ever going to be able to, follow every headline and then make an assumption? Is this going to be good for stocks? Is this going to be bad for stocks? It's kind of ridiculous. I think it's really important. Just focus on what the Fed is doing. And try to tune out most of the noise.
I think to your point there, and obviously like the conflict that you mentioned last year when like initially Russia had invaded Ukraine, that's a little bit different because Russia is a massive exporter of oil, obviously. But even looking back at the reaction in the oil markets to that interaction in the first week, you basically had oil rip like 40%, crude I'm talking about, rip 40%, come right back to where it was before the invasion, rip 40% again before ultimately slowly trickling down and selling off to minus 20% in the middle of this year. And so I think Alejandro is right in terms of looking at specific assets like oil and saying, okay, is this or what sort of impact is these geopolitical tensions going to have on oil specifically? I think that it's probably a better move to, like Alejandro said, sort of take a step back and look at the 10,000 foot view and say, okay, we do have these tensions going on, but what does that mean for ultimately the path forward in terms of the economy and how the Fed is looking at it? Because like you said, if the Fed does wind up again taking a more dovish stance, people are going to want to react to that as opposed to, I guess, the headlines surrounding the news, which can sort of last maybe for a day before sort of everything gets priced in and the market sort of forgets about it. So I think that's a great point. Second thing we can move on to here is Nvidia. So Nvidia had yesterday, the United States came out and said that they're restricting sales of Nvidia chips to China. Obviously, this has been part of an ongoing growing tension between China and the United States in terms of their sort of economic battle. Is this something that you guys sort of expect to affect the entire sector, or is this sort of just one of those short-term, I guess, blips on the radar? Nvidia obviously this year has had a stellar year and is still really trading at highs, right? They have earnings in the middle of November, so they usually do report later in the earnings season. Earnings are Tuesday, November 12th. So we do have quite a bit of a ways to go before then. But I mean, the last earnings obviously, or two earnings ago back in May, the Q1 earnings, I want to say, ripped the stock up from 300 to 400, and the stock has been trading, up here ever since. Is this something that you'd expect to maybe finally bring that pullback that it seems like every investor has been waiting for in Nvidia? And I'm sort of, talking my own book because I would love to see a dip in Nvidia so to buy it. But is this something that you guys are expecting to actually really affect, the price action here, over the coming days and weeks and months, and hopefully get that dip that we're expecting?
I'll start this off. First, I want to say I found this thing so wrong, the sanctions that were placed, because if you remember going back just a few months, there was initial sanctions that were placed on the brand new A300, or I forget the new top of the line chip that they made that's really driving generative AI. They put restrictions on that going out to China. So what Nvidia did is turn around, sink millions and millions into investment to downgrade it to a chip that would follow the sanctions just imposed. That way they could still drive out sales to China. And now, right as they are selling these new chip they designed specifically for China post sanctions, again, the US comes back and says you can't now sell that either. So in terms of a business, I think this is super wrong what they're doing to Nvidia. But coming post news, their CEO Jensen came out and said it's going to be materially indifferent, really, in terms of revenues, at least for the next year going forward. And so in terms of stock price, I think this dip probably gets bought up if you get a knee-jerk reaction this week. I think investors are still keen to own Nvidia, and I think this probably gets bought up versus seeing like a 20% corrective move. But just in terms of what they're doing to Nvidia here, I understand it from a geopolitical, issuance point, but I think it's really wrong to go back on the sanctions you just imposed after they sunk millions of dollars into investment and R&D, and then say now you can't sell that either.
That's a good point. I mean, it is kind of messed up. I will say that. Alejandro, any thoughts on what you're expecting, I guess, out of Nvidia, or any thoughts on the new sanctions that have recently been levied?
Yeah, so I just took a look at the chart, and clearly it's seeing some short-term downside. I don't know that we'll have any real idea how much of an impact this will have on the company itself until maybe Q1 earnings. So as far as like seeing a 20% correction, especially, if stocks perform well as we expect them to into the end of the year, I don't think that we'll see anything that crazy. But if this has, a bigger effect on the company, we won't know really for a while. So short-term price action, it seems like the news is priced in. That's typically how it works. You get that initial severe reaction. Important to watch over the next couple of weeks, I guess, if there's continued weakness, especially if there's relative weakness, if stocks as a whole, if the S&P 500 is performing well and Nvidia is not, that'll be troublesome for the stock. But I don't think it's anything to be too concerned about unless the broader landscape really starts to change in some obvious ways. And again, I don't think we'll know for a little while.
Understood. All right, last question that I've got for you guys is related to Bitcoin. So one of the things that I've been hearing over the past, really since the tension sort of broke out in the Middle East, is how Bitcoin could sort of be viewed as like one of the safe haven assets that people might want to make a push for. And Mander talked about people moving into safe haven assets, U.S. Treasuries, gold, and Bitcoin sort of is, I guess, being questioned as making the list. And then obviously you have the other headline of the fact that they're trying to currently launch the spot Bitcoin ETF. BlackRock is sort of heading that movement at the moment. And it seems like it's more a matter of if as opposed to when that spot Bitcoin ETF gets created. Are you guys a buyer of Bitcoin here on, I guess, probably more the spot Bitcoin ETF news than the push for a safe haven asset? I'm sure that you guys can go out and hear about the news of the invasion and immediately go buy Bitcoin. But I'm more asking about the spot ETF. Is this something that you guys could see, being supported for Bitcoin in terms of price action? And are you guys a buyer of Bitcoin here or in the near future on this news?
I'll start this one off. I think definitely on the spot ETF approval, should we get it from the SEC, I would be a buyer in Bitcoin solely for that reason. But in terms of looking at Bitcoin as a safe haven asset to hedge the stock market, I'm going to completely fade that narrative as really the whole stock chart has shown. It pretty much trades linearly with the NASDAQ. And so for anyone to say that Bitcoin is going to be trading as a safe haven asset, it does not inverse the equity market in whatsoever way. It's literally pretty much the exact same thing, probably farther on the risk curve than any stock you could find. So I'm not going to buy it in that news, but I am interested here in the spot ETF because I think a lot of the narrative going around the crypto market right now is not that people don't want to own Bitcoin. It's that they're struggling to find a brokerage that they feel trustworthy in. And so there's even been recent headlines on Binance now and CZ going out right now that the whole Binance token is having issues and this, that, and the other. So should Binance go under, that's really your last major one besides Coinbase. I think there's a lot of fear just around brokerages. And so if there's a way for people to get involved in Bitcoin without having to go through some sketchy brokerage, I think that's a really bullish narrative to get into, specifically Bitcoin, but probably the whole crypto market.
I will say before I go to Alejandro, Larry Fink, BlackRock CEO, says that Bitcoin or BlackRock currently has what is this, trillion? No way. I think it is $9 trillion worth of Bitcoin, which is pretty nuts. And he's the one who described it as a flight to quality. That was his words, which is why I'm sort of asking the question. That's from the man himself, the BlackRock CEO, calls it a flight to quality. I mean, obviously, like a bit of like perverse incentives there because like he's the one launching the spot ETF, obviously. But what I wanted to say to Mander is that if it is sort of like, shouldn't that be priced in by now? That like I wouldn't be a buyer on the day that the spot ETF gets approved because it's more of like a when at this point, right, as opposed to an if. So I mean, theoretically, it should be priced into the market if the market is efficient. So I don't know, Alejandro, what do you think?
I think Mander did a good job of covering it. The only thing I'll say is I'm really surprised that they're still getting away with calling Bitcoin a safe haven. Like, I agree with it. I mean, it's like ridiculous. It's like owning a small cap, in my opinion. Like, I don't know. Bitcoin as a safe haven play, definitely not. Understand that your money could disappear pretty fast if you are buying crypto. That's the only thing I wanted to add. Your money can literally disappear. Like, not only just from like my money and
On the exchange.
money, like my money literally disappeared. Like when I was transferring it from like one spot to the other. So
yeah, that's crazy. I mean, I found a tweet while you guys were talking. Direct quote from Larry Fink, 2017. Crypto is an index of money laundering. Direct quote, Larry Fink. That was 2017. Direct quote, Larry Fink, 2023. Crypto will play a role as a flight to quality. We're launching a Bitcoin ETF. So there you go. That just shows how times can change. Pass back to Alejandro.
all right. It's because he found a really good business opportunity. What a guy. What a guy. All right. That's going to do it for this morning's episode of Beat the Bell. Appreciate you guys tuning in. We'll be trading live in the Kane Cap Discord. You guys can go to kane-capital.com or scan the QR on the code. We got the 7-day free trial going. Other than that, have a great rest of your day, everybody. Thanks for tuning in, and we'll see you on Friday morning at 8:30 a.m. Eastern Time. Take care, guys.